Hello, today's February 25th, and we're going to talk about GameStop. The stock went from the low 40s yesterday all the way up into 90 at the close, and actually at one point after hours was over 160 bucks a share. And so we want to talk about what we saw as the reason for that. You can see this post on our website, SpotGamma.com. You can go to the GME Gamma Squeeze round 2, and we're just going to walk you through some of the charts. The first thing that we would note, there was a small piece of news yesterday. GME had a few changes as to their C-level hires, and so that kind of was the impetus for some people to think that was a really bullish move. That stuff in GameStop from a fundamental basis was going to change. What's interesting is this is the open interest from Tuesday, and you can see there's a ton of put interest. That's what all these bars are telling you. And there's call open interest that's pretty evenly dispersed throughout, really 50 all the way up into and over 300. There's a ton of call open interest. In fact, the most calls, as you can see, are concentrated at the 800 strike. These are obviously extremely far out of the money, and we don't think really played into a factor in yesterday's rally. But essentially what happens is as the stock moves up, all of these puts start to lose value, right? These are all concentrated around 20, 15, 20, 25. And so when the stock goes up, these puts all start to lose value. So dealers and market makers can start to unwind short hedges, because if these are long puts, dealers are short these puts versus short stock. So anytime this moves up or anytime these start to decay, dealers can start to buy back stock hedges. So here we have the stock is going to start moving higher. All these puts are going to lose value, and we can start as market makers to start buying stock back. Now, as that's happening, these stock positions here, assuming that they are long positions, meaning long options positions, that means that dealers would have to buy stock to hedge these. So we have buying flows here from hedges, and we have buying flows from here from hedges. Now, let's say, for example, that this 46 strike is a short call, right? That would mean dealers are long those calls. This is likely to be forced getting closed then, right? I mean, if you're short the 46 strike or 45 strike call and the stock just went to 90, you're probably going to get a margin call, right? You're probably going to have to adjust this. You're going to have to make some sort of adjustment. So we think that either way, really, when you get such a violent move higher, you either have dealers buying back or buying stock, right, as a long hedge, or people are closing short call positions. And when they do that, that's an immediate, again, buy from an options market maker, right? That's essentially another way of squeezing. So if you look at actually the flows that took place yesterday, you can see those flows here in blue. And what we're showing here is the estimated hedging volume on a rolling basis. And we like to look at it as a rolling basis because you can see the net flows really over the day and what the requirement was. And what's interesting here, the blue line is those hedging requirements in terms of number of shares. And it's a pretty good amount of shares, right? Over 400,000 shares roughly that would have to be bought as a delta hedging requirement. But those flows really start to pick up. They're very concentrated around 3 o'clock. Note that the X scale here, the time scale, is adjusted based on the amount of flows that were taking place. So 9 o'clock is here, but 1 o'clock starts here because there was not much options volume in this time period. It's really after 1 o'clock that these flows really start to pick up. So it's important to adjust that. And this is telling us that after 1 o'clock, net buying options flows picked up in the name. And that makes sense because the stock really went crazy. So you have a lot of people sort of jumping on board. But we also think that essentially this is telling us that the pump was already primed for kind of a gamma squeeze if the stock could really start to rally. And then new flows came in on top of that. So all of that is just bullish options flows that come in. And you can see here, we marked this. This is the 1 o'clock hour, and it's really around here, 2:30, that this starts to pick up. And then this is where you're getting new flows, and the gamma squeeze really starts in earnest, and you really see the stock start to drive up, right? And we think a lot of this is, yes, retail buying the stock, but it's clear that there's a lot of options flows that required stock buying. So here's where you get that squeeze. Now going forward, we want to talk about a few things. First, what's interesting is if you look at the cost of an option, which you see here, the best deterrent that market makers have to stop new call buyers is to raise the cost of a call option. And so What you see here in this chart is the relative cost of an at-the-money call option. So if GameStop is 100, the at-the-money option is a 100 strike option, 100 strike call. And you can see that the closing value of these options yesterday was very, very high. Each dot represents a different expiration date. So you can see that relative here with the stock around $100, which is what this thin blue line is, the options prices were just way up there, right? They're all up in this 30% cost, meaning it would cost you roughly 1/3 the price of stock to buy an at-the-money call option. Now, when the stock last did this big price jump in this neighborhood, you can see how relatively cheap those options were, right? The cost is not the same. And so what this is telling us is that market makers aren't messing around this time, right? They're raising the cost of options immediately to an astronomical level to immediately try and cut off that call supply, right? To immediately cut off that new call volume. Because if their inventory is full, they still have to make a market, right? If they're the primary market maker, they have to make a market. So their main choice to deter buying of options is to raise the cost of those options up. And we talked about this in the last time GameStop went from roughly 200 down to 60, that once they raise the cost of those options to such an astronomical level, people don't want to buy them anymore, right? And if you're long those options, you probably want to sell them. So when call sellers start to come in, then dealers can start to sell off their long stock hedges. And we think that is a major force that will help drop the stock back down. We saw this before, and we wrote about this in Tilray and some other names after this initial GameStop kind of blow up. With the stock really leapt higher in this last end of January session, we saw prices in like Tilray and some of these other high-flying kind of meme stock names. We saw the implied vol immediately jump extremely high, and that really kind of choked off a major supply of that gamma squeeze, right? If there's no new options positions added, then that gamma squeeze really starts to die down pretty quickly. We note here, we show the same chart, as above in this, but in this case we split out call and put volume, and you can see that the call IV is so much higher than put IV. This is the stock crashing higher essentially yesterday, right? That's what this is reflecting. So obviously huge call demand, which is not terribly surprising, but we think again, this is just showing how expensive calls got very, very quickly. And we think that will really choke off supply here, and for that reason, we don't think that the stock is going to kind of sustain these major price hikes like it did before, right? We just don't think it's going to break 200 and kind of get up in this 200-300 area. Now, the caveat to be with if everyone just sort of says all we're going to do is buy stock, right? Retail without options can, I guess, try to force that stock higher, but it's going to be very tough, right? Because if you're not using options, you lose leverage. If you buy one call option, you could force a market maker to have to buy 20 or 30 shares of stock, right? But if you're just going to buy one share of stock, well, that's it. Your demand is done. There's also no further gamma hedge, right? So if you buy that one call option, a dealer has to buy 20 shares of stock. Then if the stock goes up, the dealer needs to buy more stock and more stock and more stock. As a retail investor, if you just buy one share of stock, you're not getting that same leverage, right? You buy your share of stock and the demand is done. There's no market maker that's left to have to keep buying. So the key levels here now are 95 is where we see the biggest concentration of gamma positions. So we think the 95 to 100 area is where that new sort of center of hedging gravity is. And we would look for the stock to come back in to that area, assuming that call volumes are not the same as they were yesterday. We see brokers are already starting to adjust margins and making some changes to their risk metrics. And so 95 would be sort of the key area. The 95 to 100 level is sort of the key area that we're watching for support in the stock. If you like this analysis, you can go to SpotGamma.com. We talk about the unwind in a post called the GME Gamma Trap, which you can see not only on our website but also on YouTube. So if you go to SpotGamma.com, you can also check out our Equity Hub tool, which allows you to view over 3,500 different names and do your own options-based analysis, as you can see here. Please send us any comments. You can see us on Twitter @SpotGamma or send any questions to info@SpotGamma.com. Thanks.